What if I told you that the crypto you're holding right now could suddenly become restricted, heavily regulated, or even lose value overnight? Not because of the market, but because of new rules? At the same time, some cryptocurrencies could explode in value simply because they fit into the right legal category. This isn't speculation, this is exactly what's happening. As the SEC and the CFTC move forward with new guidance to reshape how crypto is regulated. For years, crypto has lived in a legal gray area, where no one fully knew whether it should be treated like stocks, commodities, or something entirely new. This confusion created massive uncertainty, lawsuits, and fear among investors. But now regulators are stepping in to bring clarity. Whether you're a beginner or an experienced investor, understanding these changes could be the difference between making money and losing it. At the center of all this is a concept that dates back to 1946. A legal case called SEC v. W.J. Howey Co., which introduced the Howey Test. In simple terms, it asks, are people investing money with the expectation of profits coming from someone else's efforts? If the answer is yes, then that asset is a security and must follow strict regulations. If not, it falls outside those rules. Applying this test to digital assets has always been complicated. That's why the new interpretation introduces a clearer classification system called token taxonomy. According to this framework, some cryptocurrencies are classified as digital commodities. These derive value from supply, demand, and a decentralized network. A well-known example is Bitcoin, which operates without a central authority and is driven by market forces. These assets are not considered securities. Then there are digital collectibles, including NFTs and memecoins. These are valued based on uniqueness or culture rather than a promise of financial return. Another category is digital tools, which are tokens used for access, membership, or utility within a system, falling outside securities laws. Stablecoins like Tether are designed for payments and pegged to assets like the US dollar. They are generally not considered securities when used for transactions. However, the category of digital securities raises concern. These behave like traditional financial instruments, where investors expect profit from a team's efforts. If a token falls into this category, it must comply with strict regulations, which can significantly impact its future and availability. One important aspect is that a crypto asset's classification is not fixed, it can change over time. When a project launches, it relies on a team making promises, making it a security. But as the network grows decentralized, that may change. The guidance also clarifies mining. Mining is not a security because miners use their own resources to secure the network for rewards. Staking is clarified as a service rather than an investment contract, as long as rewards come from the network, not a central entity. Wrapping and airdrops are also generally not securities, as wrapping mirrors an underlying asset and airdrops involve no investment. What does this mean for you? It brings much-needed clarity. You can understand which assets face strict regulations and which don't. However, it introduces risks. Tokens classified as securities may face legal challenges or delisting, impacting their value. At the same time, it creates opportunities. Projects that align with guidelines could attract institutional investors and experience significant growth. Regulation is no longer something to ignore. The days of the Wild West are ending. Governments are stepping in to make crypto stable and secure. This could lead to greater adoption into the global financial system. But investors need to be more informed and strategic. Looking ahead, this is just the beginning. While these interpretations provide guidance, full regulation will likely require action from lawmakers. For those who understand these changes, there is a clear advantage. You'll be better equipped to avoid risky investments and identify strong projects. The crypto market is evolving, and those who adapt to these changes will be the ones who benefit the most.